Welcome back to Decouple. Today I'm joined by Leigh Goehring, who is a managing partner at Goehring and Rozencwajg and a returning guest here on the Decouple podcast. Leigh joined me last year for a great episode we called The Energy Poverty Returned on Energy Malinvested, and that was based upon a natural resource market commentary released, I believe, in 2022. It had a great analysis of energy return on energy invested, diving way back into the past, and I've actually quoted it fairly frequently because you guys spoke about the sweet spot we had from 2010 to 2020 when all four primary sources of energy, be it uranium, coal, oil, gas, dropped from peak to trough by 90%, and we had the cheapest interest rates in the world. So very influential quarterly report. I recommend listeners sign up to it. But I just got a new one in the inbox recently, and it's was called The End of Abundant Energy and talked about the need to revisit the old theory of peak oil. So Leigh, I'm excited to have you back on to discuss this. Thanks for making the time for us.
Oh, thank you, Chris, and thanks for having me back on.
Okay, Leigh. So, let's just jump into this. When I was in university 20 years ago, it's feeling like a long time for me. Peak oil was very much, maybe not in the public eye, but certainly amongst folks, looking at energy and thinking in broad strokes. It was on the agenda, and that's really disappeared. And I'm just getting these slight signals in the signal to noise ratio. People are starting to chat about it again. You guys in this report have done a pretty thorough analysis of the shale sector. But perhaps we could start out by jumping back to that period in the early 2000s and the context for some of that initial anxiety about peak oil at that time.
Okay, yeah, and I think we should step back even further. Just give our listeners a little bit of a overview of what peak oil is and the theory of peak oil and who King Hubbert was.
Yes.
King Hubbert, who is really considered the person who originated the theories about peak oil, was a shale geologist who did a lot of his work back in the late 30s, 40s, and 50s. And he was quite a controversial person. I, of course, never met him, but I've met a lot of people who did know him, and they said he was quite a cantankerous person. But the thing is that he eventually came up with these series of theories that you could use mathematics to model the production profile curves of individual oil fields and individual oil producing regions. And he believed that he used these models, that what you could do is you could not only project a production profile of that field or energy producing region going forward, determine when it was going to plateau, and then you determine when it was going to decline. And he made a very famous presentation at the annual meeting of the American Petroleum Institute back in 1956, where he was the keynote speaker, and he said, there's the people in this room. I'm going to make quite a bold prediction here, and there's not going to be many people that are going to believe me. But here we are. At the time, I believe oil production was about 7 million barrels a day. He said, based upon my theories, is that oil production is going to grow to almost 10 million barrels a day and peak in the early 1970s, and then to begin to decline. And he actually made two predictions. He said, I'm going to make two predictions today, one based upon 150 billion barrels of recoverable oil, the other on 200 billion barrels of recoverable oil. And then he refined that back in the early 60s and said, okay, let's use the 200 billion barrel figure. And what that said is that oil production would peak at a little over 10 million barrels a day in the early 1970s, which it did exactly. And of course, he became quite famous for that. And then people began to use his theories to try to extrapolate when total global oil supply could potentially peak and then decline. And those theories obviously didn't gain much traction in the 1980s and 1990s, which were a period of very, very strong oil supply growth. And people just said, okay, Hubbert's discredited. And then something began to happen in the early 2000s. And you made reference to this, Chris, before. And all of a sudden, his theories became quite well followed again. And what happened was that there was a very unusual and pronounced slowdown in non-OPEC oil supply. In fact, between 2003 all the way to about 2008, we had a period of close to 5 years where non-OPEC oil supply basically didn't grow at all. And there were a couple of real good reasons for that. And we back in that period, we wrote a bunch of papers on the subject, and I was profiled in Barron's in I think it was January 7th, 2004, saying that we were going to see this very pronounced slowdown in non-OPEC oil production, which indeed occurred. And a lot of that was because of various Hubbert's theories at work in various parts of the world. For example, the North Sea had plateaued and begun to decline. Prudhoe Bay had peaked, plateaued, begun to decline. The Cantarell field in Mexico, which people don't pay much attention to, but it was the world's second biggest oil field, peaked in 2004, 2005, and then began a very steep decline. And it was the declines in all these areas that basically prevented non-OPEC oil supply from growing. Now, why is that so important? Well, I've said this forever, and I'm going to say it again today because it's going to be a consequence of the various things we're going to talk about, is that the biggest competitor to OPEC oil is non-OPEC oil. And when the supply of non-OPEC oil begins to slow, what happens? OPEC gets pricing power. And that explains almost perfectly what happened between 2003 and 2008, where basically oil ran from the high 20s all the way up to about $145 a barrel. And it was because of that slowdown in non-OPEC oil supply that allowed OPEC to gain pricing power, which of course they did. And that was, so Hubbert's theories were trotted back out and became popular. And there's a lot of chatter that went back and forth that this is something that we really should, understand a lot better. And then something else happened. And what that else happened was the unlocking of how you produce oil from the oil shales. And what we did is we basically used the technology that had been perfected in producing gas from the gas shales in the early 2000s, which started with the Barnett Shale and then the Fayetteville Shale. And I'm going to bring those back up a little bit later because they're very important, what's happened to those fields and how what's happened to those fields has applicability to the big shales today. But anyway, so at first we just realized we could produce oil in the the Bakken field up in the Dakotas. We then figured out we could get oil out of the Eagle Ford shales in South Texas, and then we discovered that we could unlock all the oil that was in the shales in the Permian Basin. And what happened was that all of a sudden, U.S. oil supply, which I mentioned before, peaked at 10 million barrels a day in 1970-71, had reached, had fallen almost to 5.5 million barrels a day by 2008, 2009, all of a sudden began to grow very, very strongly.
And in your report, you liken this to, because we can use a lot of numbers here, but for the enumerate out there as myself, you said I think it's the equivalent of adding 1 or 2 Saudi Arabias to global oil production.
And that's exactly right. Don't underestimate the impact of what the shales did to the world economy over the last 20 years. For example, between the oil that's been produced in the oil shales and the liquids that were produced out of the gas shales, that was almost 0 to 11 million barrels a day of oil/NGL production. And that's the equivalent of discovering an entire new Saudi Arabia. And what's interesting is that from the time oil was discovered in Saudi Arabia just after World War II to its peak in the mid 60s, there was a 40-year, it was 40 years to go from 0 to basically 10 million barrels a day. And we did that in 10 years. And wow. So that was one Saudi Arabia equivalent discovered. The second was what happened in the gas area. Is basically, between the originally the Barnett, then the Haynesville, obviously the Fayetteville, and then the Marcellus, and then the Haynesville. We basically in a oil equivalent measurement, we discovered another Saudi Arabia just in the gas itself. So between the gas and the oil, we found two Saudi Arabia's equivalents in the United States. That's incredible, and it had the impact of that is really hard for most people to imagine. But it did produce this period of unbelievably cheap, abundant energy.
Right. And we're going to get into some discussions about the kind of value destruction that occurred in a second there. But, something that we've been looking at recently is the importance of heavy distillates, in terms of running diesels, in terms of heating oil, et cetera. And that's, while the U.S. Has become so-called, energy dependent or, independent, particularly from the perspective of oil. Is it true to say that a lot of the shale oils that we've recovered have been light oils that produce a lower fraction of heavy distillates like diesels, et cetera?
Yeah, overall, the problem with the shales in the U.S. and how it impacts the refining system is, remember, over the last 40 years, the amount of light sweet crude, which is your most desirable crude, and which, for a variety of reasons, is that's been declining, and it's being replaced by less desirable crudes. That is, crudes that are heavier and have more sulfur in them. And so the idea that over time, what the U.S. has done, the U.S. refining system has done, is that they basically migrated their refining system over from being able to process light sweet crudes to be able to process heavy sour crudes. And what happened is that with the shales, remember, the shales are all light sweet crude, very light sweet crude. And all of a sudden you had these light sweet crudes that were in abundance. You had a refining system that basically could run them through them, but run it through their system suboptimally, wouldn't get the proper yields. And so the thing is that you were running the US refining system in a system that basically was being run suboptimally for that time period. And you saw that in the huge differentials in the pricing that occurred between, for example, Brent pricing, which was more representative of world price, and the U.S. price, which often traded at some points in the early part of the 2000s decade at almost a $20 discount to the world price. And that's because that's what you had to discount it through, to put it through the refining system, given the fact that it was a suboptimal input.
Right. I was paying attention to a fellow named Art Behrman, and he was looking at crude oil production and noticing that 40% of what we historically would have called crude oil nowadays is no longer based on crude oil. I think about 30% are natural gas liquids. They're also counting things like ethanols in there, and he was suggesting that this points towards the fact that we may already have reached that peak oil point. Do you think that holds water?
Oh no, I definitely do, and I'll give you, I'll show you some of the statistics, or talk about some of the statistics that point that out. Is that if you look at just conventional oil on a global basis, and say let's look at the non-OPEC world, is that conventional oil production in the non-OPEC world peaked all the way back in 2006, and today we're producing about 2 million barrels a day less of conventional crude oil in the non-OPEC world than we were doing in 2006. Total world conventional oil production looks like it peaked in 2016, and now we're down almost 5 million barrels a day versus that 2016 peak. Now, however, global oil production has grown by 10 to 12 million barrels. Or it's almost 10 million barrels between the early part of last decade. And so where did that oil supply growth come from? It came from only three sources. The majority of it, close to 80% of it, came from the U.S. shales, and the U.S. liquids, from the shale gases. The other big component, which people don't talk too much about, you just mentioned ethanol, is biofuels. In the sense that, other than the shale oil production over the last decade, the second largest global growth item in various oil balances is biofuels. And we could talk about the ethical quandary that surrounds that. Should we be growing crops to produce so soccer moms in the U.S. can drive around in 2-ton SUVs. I mean, that's a whole different issue. And then the third source of some oil supply growth over that time period since the early 2000s has come from the oil sands up in Canada. But that's an unconventional oil sands source of oil as well. So your only source of growth in global oil supply over the last 12 years has come from unconventional sources, not conventional oil. It's come from the shales here in the United States. It's come from the oil sands up in Canada, and it's come from biofuels. So Mr. Berman is definitely right about that. And what's so interesting about that is if you want to talk about Hubbert's peak, is you could make the case that we have gone over Hubbert's peak as far as conventional oil supply.
When confining the conversation to conventional. Well, maybe this is a good leap-off point just to very briefly talk about what the shale revolution is in terms of fracking technology. And we don't need to go into a lot of detail here, but I think one of the important elements to it is that we're tapping the source rock. So how is fracking different than conventional gas extraction? And what are the limitations in terms of is this the source rock? Is this the end of the end?
You can say that this is the end of the end, unless you want to get into the whole concept of abiogenic gas and things like that, which is, that's a whole other subject, and that's something we can't prove today exists or not. But the thing is that obviously, since the day that crude oil began to be part of the global economy, which was after Colonel Drake discovered it in 1852 or whatever in Oil City, Pennsylvania. All the oil that's been produced has been conventional, and where that conventional oil comes from is that conventional oil comes from organic matter that has been deposed, sometimes as much as several hundred million years ago, and into the surface of the earth. Over time, all that organic matter has been covered over, been pushed down into the earth's into the crust, where it reaches a point where the temperatures and pressures get so great that the organic matters it's turned itself into shale, that the organic matter in that shale begins to crack under the high temperatures and the high pressures, and the molecules, whether it be methane or actual oil molecules, begin to migrate out of that shale, that source rock, and begin to migrate up into the higher levels of the crust. And then it would get trapped. And it would get trapped in what they call usually an anticlinal structure, an underground mountain that had to have a seal on the top so that when the hydrocarbons got into that trap, they didn't further migrate to the surface. And then of course, they were sitting there just waiting to be discovered, which they were in the last 150 years. And that, what I just described is the by which where 99% of the oil has come from. Now, the question was, we all know that those shales, those source rocks that were beneath all these conventional oil fields, we knew they were there. We knew that was the source of the oil, but we just didn't know how to get that oil out. And the reason is that in conventional oil, the rock, which is usually, say, is sandstone, when you think the old sand that's on a beach that's been compressed, has a lot of permeability. That is, there's ability for those hydrocarbon molecules to flow within that rock. And however, in shale, the permeability in shale is zero. And so the question is, even though there's hydrocarbon in that shale trapped in there, how do you get it out? And so was what the beauty of hydrofracking allowed to happen, is that what you did is you drilled a well. And what was interesting, most of these shales are, the columns are not big and thick, they're relatively narrow. So in order to expose a wellbore to a significant length of shales, you had to drill horizontally. You couldn't drill vertically. And then what you had to do is you had to inject huge amounts of energy into that shale rock to fracture it and create artificial permeability, which then had to be, remember, propped open by sand so it wouldn't reclose. And then those hydrocarbon molecules could flow out. And that's the shale revolution. First, they perfected all those techniques in gas with the Barnett and then the Fayetteville fields in the early 2000s. And then we perfected it in the oil shale, starting with the Bakken.
Right, right. And I mean, this really took off, as you said, adding a Saudi Arabia of natural gas and a Saudi Arabia of unconventional oil is just a massive increase in accomplishment. Why did this happen in such a quick fashion and maybe not such a controlled fashion? I understand a lot of money was lost on Wall Street because of the glut in natural gas prices that came. Why did things go so crazy?
It's interesting. The whole concept of being able to unlock the hydrocarbons that were in shale has been in people's minds for a long time. And of course, I recommend everyone to read the book, The Frackers, that and I believe it was written by two Wall Street Journal reporters. And it describes George Mitchell, who was the CEO of Mitchell Energy, who had this theory that we're someday going to be able to unlock the mystery of how to get those hydrocarbons out of the shales. And he pursued it for years and years and years with a lot of setbacks and things like that. But by the year 2000, for some reason, they figured out what they were doing. They figured out the technologies, what they had to do, and they were successful. And after that, once that was successful, then as usual, there is like the California gold rush in 1850, is that there's a huge amount of capital and people that want to go in to exploit this new resource. And that's what they did. And like I said, it first happened in the Barnett and then in the Fayetteville. But and then we said, okay, where are these other shales? And we knew where they were, and we figured out how to delineate them, and then the techniques needed to optimize the drilling and production of hydrocarbons from them. And that's we threw a massive amount of capital at that. And like I said before, we discovered the equivalent of two Saudi Arabias, one in gas and one in oil.
So this overproduction that occurred, though, because I'm trying to get a sense now. What you're arguing in the report is that these fields are starting to behave a lot like conventional oil fields or conventional gas fields. The hypothesis here, and I think you've got some neural network AI technology that's been crunching a lot of data on this, is that these fields are starting to peak and decline as Hubbert's curve would have predicted. Tell me a little. I mean, this seems like 10, 15 years for that to occur. This idea of peak oil has really receded into the background. I think people, are almost kind of laughing or mocking a lot of the folks that got caught up in it. They were, proven wrong, I guess, on some of the dire predictions that were to come. But what you're saying is that we should be a little bit careful and take a closer look at these ideas. So again, I'm just trying to get a sense of how quickly we're burning through these reserves. And ultimately the impact that's going to have on our societies. I mean, don't need to answer that in just this one question, but
Yeah, well, there's a couple questions that you have there, Chris, and I'll approach
yeah,
both of them. Well, one of the things is that going back, I was saying, remember, conventional oil has peaked and is now in decline. And the only reason that we've seen any growth in global oil supply over the last basically 10 to 12 years is because of primarily the shales, a little bit from biofuels, a little bit from oil sands in Canada. But it's been primarily 80% of it has come from the shales. So the question is that what happens if the shales all of a sudden stop growing? Because once the shales stop growing, then all of a sudden we're going to start realizing, hey, conventional oil production on a global basis is now in decline. And at that point, we will begin to have to refamiliarize ourselves with concepts like Hubbert peak. And it's so interesting. Obviously, like my brother just emailed me right now. There's a story in Bloomberg today, again, saying fears of Hubbert's peak are reemerging, and all of a sudden, people are beginning to recognize why this is happening, or that it's something that is in the process of taking place. Now, why is it taking place today, and how quickly will this take place? Basically, there's four big oil shale basins in the United States. There's the Bakken, there's the Eagle Ford, there's the Permian, and there's the DJ Basin out in Colorado. Now, of those four, both the Eagle Ford and the Bakken have peaked and are now in decline. And we'll talk about our neural network in this a minute. And the thing is that the Permian is still growing. So we still have some growth in the Permian left. However, think of it this way. The entire global oil industry, as far as its growth, is now dependent on basically 6 counties in West Texas. That's the only growth that's taking place in global oil supply today. Everything else is either plateaued or in the process of decline right now. So once the Permian actually begins to decline, then all of a sudden, where's the next great source of oil supply growth going to come from? And the question is that it's probably not.
So why is that? Are there not other countries that have similar geology as the U.S.? Is it just their lack of technology to unlock their shales, or what's the limiting factor?
You bring up a really good point, Chris, that absolutely no one, for whatever reasons, I'm a little bit mystified why no one has done any research on that, but we have at Goehring and Rozencwajg Associates. And that's a question that people always said, well, can't we export the shale gas, the shale oil revolution to the rest of the world? There is a lot of shale in the world. And that's correct. There's shale all over the place. Now, what's interesting about that is that it turns out that not all shale is productive for hydrocarbon production. It turns out that you need 4 or 5 characteristics in the shale for it to ultimately successful to be a hydrocarbon producing basin. For example, you need a certain thickness of the shale. If the shale is too thin, you can't get a drill bore through it and contact enough of the shale to make it productive. The shale has to have the right organic content. The shale has to be formed in the basin of a marine basin and not what's called a lacustrine basin, which is the bottom of a lake. Why is that important? Well, you have to have the right geochemistry of the shale. You have to have a lot of silica and not a lot of clay. If you've got too much clay and not enough silica, the shale will never produce. It has to be in a seismically inactive area, because if it's in a seismically active area, the shale will get all broken up and you will not be able to interject that huge amount of energy to wind up fracturing it. And finally, it has to have the right thermal maturity. It has to be cooked long enough at high enough temperatures and pressures for those hydrocarbons to be released. So you need all these things to happen. Well, a number of years ago, we wrote a great paper on this, is that we talked to a lot of geologists, we talked to a lot of oil executives. We said, okay, all these characteristics, what are the most important and how would you weight them if you wanted to determine if a shale was being productive? And we used their inputs and their suggestions, and we built a model. And what we did is we modeled all the shales in the world based upon this model, and we ranked them. And you say, well, how in the world did you do that? Well, it turns out that the U.S. Geological Society has mapped all the shales in the world and has put many of those characteristics that I just talked about in their database. Now, there's some missing. For example, the shales in the Middle East are not part of that database, but they're almost every place in the world is. Well, it turns out that if you build this model, you rank all the shales, and it turns out, get this, that the 10 best shales in the world that will be productive for hydrocarbon production are of the 10, 6 of them, 7 of them in the United States.
Wow.
And the top, and it's interesting, and there are 3 others that are out there that are very productive. One is the Vaca Muerta in Argentina, which is, that's a world-class shale. And that should be developed if Argentina can ever get its political act together. The other is the Luna Shale in Colombia, which is the source rock for all the great Colombian oil fields. That's a great oil shale. But the Colombian government has put that off limits. You are not allowed to try to access the Luna Shale in Colombia. And finally, the mother of all shales is the Barashov Shale in Russia, which is the source rock of the great Western Siberian oil fields. And that is number one. That ranks number one on every metric. But the question is that will that ever be productive given all the obviously socio-political problems are in Russia today? I should point out that in 2014, when Russia invaded Eastern Ukraine and Crimea, the U.S. said to all the U.S. companies, you cannot go in there and lend any technology to the development of the Barashov Shale. And so nothing has been done there. And given what's going on. Nothing I think is going to be done in the future. But here's a great model, a test of that shale model we built. Back I'm going to take that's 10 years ago, 12 years ago. There was a little bit of a craze of companies that rushed into Poland that tried to basically drill for shale gas in Poland. And we said, not so fast. This is not going to work. The geochemistry of this shale isn't right. And I think it was ConocoPhillips. I think Chevron might have been involved in it. And there was 2 or 3 Canadian companies that went there. And of course, they drilled their wells. Nothing happened, and they disappeared. And that's because the shales just weren't right. And so the ability for us to export the shale gas and shale oil revolution to the rest of the world is going to be incredibly difficult, if not impossible.
So some really big geologic limitations there. In terms of those, that export ban on fracking technology to Russia. I mean, how complicated is this technology? How difficult would it be for the Russians to, reverse engineer it? I mean, it doesn't sound incredibly difficult, but maybe I'm ignorant.
Yeah, I mean, for example, but you need the ability to all that horsepower that you need to force those liquid and sand down into the well bore under incredibly high pressure. That you have to be able to basically underground to space your frackings to get them right, so that you frack the right amount of rock and all these type of things. And you think we all sort of say, oh, it's simple, but it turns out if you ever went to a drill site and looked at all this stuff and say, how does this all work? I mean, who's making sure that all this stuff is doing what it's supposed to do? And yet it happens. Now, I know Gazprom has been working hard to try to unlock the oil that's in some of those shales, the Barsov shales. And as far as we know, they've been very unsuccessful. So the thing is that can it happen? Yes. Will it happen? I don't know.
Right.
But the evidence so far says the Russians haven't been able to figure it out.
And so, you seem pretty confident. Well, in the paper, it sounds like your confidence around the peaking of a number of U.S. shale deposits has to do with having essentially gone after the sweet spots first. But, in terms of playing devil's advocate, how much of this could be because of limits on financing, whether that's ESG related or just Wall Street not wanting to lose its hat again, with a glut in natural gas supplies? What are the key limiting factors, I guess, in terms of the remaining shales?
I think that the key remaining factors, and we'll step back here, Chris, to talk about the framework in which we've analyzed this. You mentioned before neural network, and we talk about how we've used the neural network to try to answer those questions. Is how much drilling is left in the shales, and what will their production profiles look like? A number of years ago, when the shale oil and gas revolution was really going, there was a common belief among energy analysts, outsiders, even people within the oil industry, that the amount of oil and gas that could be produced from shales was almost unlimited. And it was unlimited because what we were doing is we were learning more and more on how to drill more efficiently and better. We were changing the drilling and completion technology to the point where the wells were becoming more and more productive. And basically what we were doing is we're taking 2-tier acreage, and through increases in drilling technique, better increases in drilling technique and completion technique, we were taking tier 2 inventory and turning it into tier 1 inventory. Now, if that was true, then you should really be bearish on oil, because all that acreage could eventually be turned through with improved drilling and completion technology into tier 1 prospects. Well, okay, was that true or not? Well, we really didn't know. Everyone said it was true. So what we did is my partner Adam is quite computer savvy. He built an artificial intelligence neural network that we put all this data into it and said, tell us what's happening. Where are the productivity improvements really coming from as you look at all the data? And we had, obviously, we bought a database of every gas drill drilled in the United States with its various inputs, locations and inputs. And what the neural network came back and told us, it said the productivity improvements that everyone is talking about in the shales is not occurring because you're putting more fluid down the well, you're putting more sand on the well, you're putting more pressure, you're changing you're doing more complicated stage fracking, all this type of thing. That has very little to do with it. What you're doing is you're taking that drilling rig that is drilling a tier 2 prospect and moving it over to drill a tier 1 prospect. And so what the oil and gas industry was doing was basically just becoming more productive by just getting better to understand what were their sweet spots and moving more and more of their rigs into the sweet spots. And so that's what the productivity was, where it was occurring. Now, if, for example, if that were true, then if we knew how much drilling activity could take place in those sweet spots and how much inventory was left, that at that point, when that inventory was exhausted, that would be the end of the production growth abilities in those fields. And then we said, okay, that's really interesting, because now we know that it's high grading, which is producing the drilling productivity increases and not anything else. There was some, increasing the length of the lateral, increasing the amount of sand loading and proppant in the fluid. That did have marginal increase. There's no two ways about it. But 80% of the productivity improvements were happening because you're just drilling a well in a tier 1 prospect area. So, okay, then we said, okay, now we've got two shale gas fields that have now are now producing, now get this, perfect Hubbert's peaks. And what I'm referring to is that the Barnett Shale, which was, they really started to develop that in, say, 2002, 2003, that ramped up from zero gas production in the early 2000s and peaked around 2012 at about almost 5.2, 5.3 BCF of production a day. And it produced, like I said, a perfect Hubbert curve. Then it plateaued, and then all of a sudden it began a steep decline. The Barnett Shale today is producing about, I believe it's a little over 2.5 BCF of gas a day. It's down about 60% from its peak. And if I were to put up a profile of it, it's producing almost a perfect Hubbert curve, or a bell-shaped curve, which is what Hubbert said a oil field or a gas field should do if it's developed without constraints. The Fayetteville Shale gas field in Arkansas was with their first successful there with wells were in 2005, and that field ramped up from zero to almost 2.5 BCF of gas production a day, almost 3 BCF of gas production a day, peaked and then declined again in a perfect bell-shaped curve. So if we say, okay, neural network, tell us what characteristics were going on in those fields, drilling patterns that caused those peaks and then the fields to decline. And what the neural network came back and said, when you drill 60% of your tier 1 prospects, and the neural network can map, it will map the fields for you and say, this is where your tier 1 prospects are. It says, when you drill 60% of those tier 1 prospects, you're going to plateau and begin to decline. And if you looked at the Barnett and the Fayetteville fields, they began to plateau a little bit before that. They peaked and then declined exactly when they hit their 60% saturation of tier 1 inventory drawdown. Now the thing is that both the Bakken and the Eagle Ford Shale have reached their 60% of their tier 1 inventories have now been drilled, and those fields are in decline, just like the models say they should. And what's so interesting, that leaves the Permian as the only source of shale growth, the only source of oil supply growth in the world. So when is the Permian going to begin to plateau and then begin to decline? And our models said that we probably still have close to a year and a half of production growth left in the Permian before it actually begins to plateau and decline. However, we should begin to slow as we go into that plateau phase.
Right. And so again, just to confirm this, this decrease in production, is not happening because of decrease in drilling activity, because of underfinancing from Wall Street. Now, we talked, I think, about drilled and uncompleted wells and how that inventory was dropping off. I just want to, I mean, it sounds like you've looked at this enough and found this pattern enough, but I'm just wanting to confirm that crystal clear in my mind, because I have heard that there was kind of a overinvestment early on. And this decline, is it being driven at all by underinvestment?
No, I think what it's being driven by, and the people talk about an underinvestment. They talk about companies getting more disciplined, returning capital to shareholders, and things like that. That's, if you want to be cynical, you say what they're doing is that they are doing exactly what they should be doing, given the fact that their tier one inventories have now been drawn down. And think of it this way: there's two things going on why companies are not drilling. One is that they're running out of tier one prospects. And think of it this way. Say, for example, I'm a big Permian player, and I've got 7 to 8 years of tier one inventory left. And do I add 2 or 3 more rigs and take that tier one inventory down from 10 years down to 5 years? Well, in 5 years, I've got to start thinking about how I'm going to reinvent myself. Where am I going to find the next Permian Basin? So why not just slow down drilling and just enjoy the 10-year tier one inventories that you have left? And that's one thing. And the second thing is that energy stocks have never been more cheap. And we've written about this extensively. And we wrote a big essay in one of our lectures that why are companies drilling? And one of the things is that many E&P companies now trade below their debt-adjusted per share PV10 values per share. PV10s are a SEC-mandated valuation that every company has to make once a year to determine what is the value of their reserves based upon the discounted cash flow and that will be returned to shareholders from those reserves. And if a company's trading at such a big, huge discount, it has a limited tier one inventory, and you can buy your reserves cheaper in your stock price than what the market's going to reward you for if you actually drill for them, then you should do that. And companies are acting very rationally. They're trying to conserve their tier one inventory, and what they're doing is they're buying their own reserves as cheaply as possible where they will be rewarded for it. And that's why they're not drilling today. And so the underinvestment is being caused by two very, very important and fundamental reasons.
Interesting. Well, let's step back and look at what the implications of the shale revolution were more broadly for the U.S. economy. Obviously, there were big geopolitical ripples to this. The plunging price of oil had big impacts on the influence of countries like Venezuela and Iran, for instance. But focusing more domestically to get a sense of maybe what's ahead, what was the economic impact more broadly through the U.S. economy in particular of the shale revolution?
It was unbelievably positive. Unbelievably positive. One of the big consequences of this is that people really don't talk about it too much. Is that getting back to that concept of OPEC oil supply, that if it begins to slow, OPEC gets pricing power. Well, conversely, what happens if all of a sudden non-OPEC oil supply begins to grow strongly? Then all of a sudden OPEC begins to lose market share. And what does OPEC have to do? It has to wage market share price wars. And it's no coincidence in the 2010 decade that the big price war in 2014 and again in 2020 were brought about by the fact that the shales were gaining market share from OPEC, or causing non-OPEC to gain market share from OPEC. And of course, price wars are incredibly good for the American economy. In 2014, oil in the summer 2014 was 100. By the end of December, it was in the low 40s, going down to 27 in the next year. In the 2020 price war, which is obviously brought about by COVID as well, the price went negative. And so there were huge beneficiaries to the U.S. economy because of all that oil price weakness that occurs. Now we're on the flip side of that. What happens when non-OPEC oil supply begins to disappoint hugely? OPEC is going to get pricing power, and I guarantee they're going to use it.
And just to clarify, in terms of price war, that was countries like Saudi Arabia flooding the world market with oil to make the cost of production of fracking uncompetitive?
Yes. Yeah. What they did is in the 2000 price war, we could argue whether they were waging a price war, market share war with Iran, or were they waging a market share war with the U.S. oil shale industry? But what they were doing is that they definitely were losing market share. They wanted that market share back. They realized the only way they were going to get that market share back was by lowering their prices and increasing their supply. And they were successful in doing that. But the oil price from peak to trough fell by close to 65%.
I wanted to circle back again because, again, of the importance of, as I understand it, the importance of the heavy distillates to some of the most fundamental drivers like long haul trucking, mining, running tractors, that sort of thing. And that, I've heard that the U.S. kind of diesel reserves are quite limited, maybe under 30 days. And that, you mentioned that the light sweet crude is sort of, what we've been after or what's been highest value. And a lot of the natural gas liquids, et cetera, are, in the higher part of the distillate column, and great for making plastic bags with, but not as good for running our tractors or other sort of civilization dependent machinery. Am I off base on that, or is that an accurate summary?
That's somewhat accurate, but I would say that the big problem, which is distillate production, at least in the United States and in the Western Hemisphere, is that we haven't invested in our refining business. I mean, there's nothing prevents us from building a brand new, huge refining complex that can produce the oil that we have today that produces a high distillate middle barrel. Except we don't do it. So we've got an outdated refinery complex. You've got a crude oil slate now, which is mismatched to what it optimally can produce, and you wind up with producing things you don't want and not enough of what you do want, which in this case is the middle part of the barrel. And that middle part of the barrel is also being exacerbated by the fact is that in huge parts of the developing world, China, India, and things like that, where their big demand is in trucking, in transportation services. That's all diesel. That's all middle distillate. So the demand for it is really strong at the same time that you have various supply constraints.
So, my listeners would be remiss if I didn't drag nuclear into the conversation here, but there are many reasons why the nuclear renaissance, so-called renaissance of the early 2000s, were a bit of a flop in Europe and America. Fukushima didn't do us any favors. Frankly, the industry itself did a pretty poor job at pulling off its new builds. Vogtle was just achieving its first criticality of quite a few years too late. But another player there in terms of making life difficult for nuclear operators was cheap natural gas. You guys, I think, as a company, are pretty bullish on nuclear. What do you think the impacts are going to be of peaking of oil and gas on prospects for nuclear?
Well, Chris, that we've done a huge amount of work, and we talked about it a little bit on my last podcast with you. Is that the renewable energy business, as it's structured today, is not going to solve the problem, and the problem that being of trying to reduce CO2 output. And at the same time that it's not going to solve the problem of CO2 output, there's going to be all sorts of really unfortunate unintended consequences, of which just you have to look no further than what's going on in Europe today, in the sense that you do something like this, and we may have talked about this in the last podcast, like Germany, 25% of the electricity was produced from nuclear power. The energy efficiency of nuclear power is unbelievable. You put 1 unit of energy in, mine the uranium, process it, turn it into a gas, enrich it, turn it to fuel rods, spend $10 billion to build a huge nuclear power electric generating facility. That 1 unit of energy represented by all that comes out 100 units of energy out the other side. I mean, it's unbelievably efficient, even with the huge cost overruns of building the plants. Renewables, and then you start, gets really complicated, like where do you draw the energy boundary and stuff like that. But you can make the case that, the most efficient offshore wind farm, which, mind you, this does not account for its intermittency and unreliability, has an energy in to energy out ratio between 1 to 12 to 1 to 15. However, then you begin to talk about the redundancy that's needed. Then you talk about the storage that might be needed for that intermittency issues. And then you begin to drop that energy in to energy out ratio from 1 to 12, 1 to 12 to 1 to 15, down to maybe between 1 to 5 to 1 to 10. So, and then you're talking about situations, 1 to 5, 1 to 10, you say, well, we're still getting energy out, aren't we? Net energy out. But we're back to where we were. This is what we talked about in our last podcast. That's where we were back in 1600 with domesticated animals and burning firewood. And what happens is that excess energy that's produced in that is just enough to keep us from freezing to death in the winter and from starving to death, and to help feed our animals from which we get our work. And there's no surplus energy left. And so that's the renewable world. So the thing is, nuclear power, which is so interesting, is that it not only solves the problem of CO2 production, but it's unbelievably, incredibly efficient. It has the highest energy in, energy out ratio that there is. And so eventually we're going to drop this idea that nuclear power is a dangerous way to generate power. No one has ever been killed or even injured in a nuclear power accident. I mean, take Chernobyl out of there, because Chernobyl didn't even have a containment vessel. It was a unit that was producing nuclear fuel as well as generating electricity. I mean, completely unsafe. Take that out. Other than that, no one has ever been injured in a nuclear power incident. And they estimate that something like 400 people a year are killed by coal trains on a global basis, crossing train tracks. So the thing is that it's incredibly safe, and we're going to get over that. And so, we're going to adopt it. You're beginning to see it. You're seeing that Poland says they want to build 4 nuclear power plants. Japan has decided that, look, maybe we got to bring back all 50 someday, as well as build new ones. France has got 12 to 14 new nuclear power plants on the drawing board. So there's all sorts of interesting things happening.
It seems that the countries that are serious about it are serious for reasons that are very pragmatic. They're not climate, obviously, right? I mean, all the Eastern European countries on the border with Russia have very real concerns about energy security. Japan, in a world of rising fossil fuel import prices, makes every sense in the world to pivot back towards nuclear. I guess in the U.S., because of this boom in cheap energy via the shale revolution, nuclear lost prominence. I guess what I'm asking specifically is, do you think that there's a case for nuclear making a revival? Because fundamentally, the obstructionism of the NRC, for instance, that is malleable, but I think that malleability will come because of necessity. And right now, there's not necessity for nuclear power because we've got lots of cheap natural gas. Do you see that changing in the U.S. in particular, in a way in which we're going to see a pivot back towards nuclear?
Yeah,
just out of pragmatic need.
Yeah, that's an interesting comment, Chris. And it's interesting. If you go back and you could do a podcast on this as well. Is that obviously we talked a lot about shale oil today, but we could talk about shale gas. Now it turns out that the shale gas revolution has been like another Saudi Arabia. It's incredible. Back in 2006 to 2007, when U.S. natural gas production bottomed, we were producing like 55 BCF of gas a day. And earlier this year, we got back to, we hit 100 BCF a day. And that's 100% because of shale gas. And so the thing is that, and we have now, oil's been cheap and gas has been ridiculously cheap. If you look at, it used to be that in the United States that since you have this ability to switch back and forth between residual fuel oil and natural gas, that there was a relationship between oil and gas pricing. They basically, you take a barrel of West Texas Intermediate, divide it divide by 8, and that would give you the dollar equivalent energy that was in that MCF of gas. And for example, if you do that today, that ratio with $80 oil is basically, that says the gas should be priced at $10. And here we are at $2.50. Now the question is that $2, that's the cheapest molecule in the world by far, energy molecule. And of course, like you said, that's your marginal competition against nuclear power. It makes it incredibly difficult for nuclear power to compete. But I would say that we're just like we're ending this world of this huge positive impact from shale oil growth, we were also ending the era of huge positive impacts from natural gas shale growth. And we were talking about, the peaking of the Bakken, the Eagle Ford, and now potentially the Permian. Two gas fields have already peaked, and we believe, using the same analysis that I outlined before, that the Marcellus, the Marcellus is incredible. We've gone from 1 to 25 BCF of gas a day. 25% of U.S. gas comes from one gas field. That's never before has so much gas been concentrated in one field. And we would say that the Marcellus is plateauing right now and should start to decline at any point in the next 6 months. Yeah. And so if we begin to lose that, and the fact that we now have in place 13 BCF a day of natural gas export capacity through all these LNG plants that we've built in the last 6 to 7 years, with 2 more coming on in the next year and a half, the idea that all of a sudden, will gas begin to trade back to the world price? And the answer is yes. Is that price $10? Yes. If gas, we have another shortage problem in Europe, will get $10 be much higher? Yes. So the idea that all of a sudden higher gas prices can very well in itself push the nuclear power business into the money.
Yeah, no, I just came back from a tour yesterday, for God's sakes. I was just at Indian Point visiting the site as it's being decommissioned, and just thinking what a regret that's going to be, if natural gas prices go up. It's already a massive regret in terms of everything that was lost there.
That you bring up a great point. That was the most ridiculous thing that anyone could have ever done, and there's going to be huge ramifications involved in that. We've gotten lucky. The last winters here in the Northeast have been really mild. The system hasn't been stretched and things like that. We could have a very cold winter, or a very hot summer, or a hot summer followed by a cold winter, and all of a sudden, that 25% of that power that was coming from Indian Point, which has not been replaced by anything, will come to the forefront as the center of a huge energy/electricity shortage here in the Northeast. So the tragedy of Indian Point has not been finally written yet, but it's going to happen. That was the most ridiculous thing that anyone could have ever done.
Well, we feel the same.
And remember, all that electricity was produced with not one molecule of CO2.
Yeah, that was incredible. I've been processing my thoughts about it, and it was the kind of analogy or the mental image I came to was it was like being next to the carcass of a rare endangered species that had been shot by an environmentalist trophy hunter. I know that's a bit of a weird concoction, but just the gratuitous nature of it, and the clear ways in which it contradicts the stated goals of environmentalists. Just in the couple minutes we have left, Leigh, if you don't mind, you guys did reflect a little bit on the Inflation Reduction Act in this quarterly report. You called it perhaps the largest malinvestment of capital in history. Can you just give us briefly your thoughts on the IRA? Is it going to reduce inflation? What are the impacts going to be in terms of further distortions of the energy market?
We're going down the road that Europe went down, and the idea that you can only invest so much money and divert capital away from high energy return businesses into very low energy return businesses before it all of a sudden has huge impacts on our lives. And Europe, you've seen that. Now, Europe, it took a circuitous route in the sense that that you invested $1 trillion in renewables, you shut down your nuclear power business in Germany, and you because of the energy shortfalls that was causing, you were relying more and more on Russian gas until the Russians turned it off. So the thing is that the same thing is going to happen here in the United States. You're seeing it in places like California, where electricity rates are really they're double what the national rate is, or even more than they are. And as you spend more and more money on renewables, invest more and more money, that the problems are going to become greater and greater and greater. And what the problem is that with this Inflation Reduction Act, the way that the government is subsidizing this is just incredible. There's no caps on this. Warren Buffett can go out and it can build as many windmill farms as he wants. And the government's going to pay half of it. And not only going to pay half of it, but they are going to then give him on the first two kilowatts that he sells. They're basically going to reimburse him, pay him for that as well. And so the idea that it's the ultimate renter's paradise, but somebody's going to pay for it. Well, what is Warren Buffett going to do? He's going to cram that down. The local state utilities are going to have to buy that power at 3 to 4 times the price that the local utilities could ever generate themselves with natural gas plants and things like that. So the thing is you do that enough and enough and enough, and everyone's electricity rates are going to go up and up and up, and you have an unreliable system. So and now the government, because of the IRA Act, is given an open-ended subsidy mechanism in place for huge investments to take place, which would not have been economic, but which now, because of the subsidies, will be economic, especially if you can get the local utilities to buy all that excess power from you.
Okay, Leigh, you've been very generous with your time. Thank you for tacking on that little addition there. For folks to find you and Adam and the great work that you do and these quarterly reports, where should they go for that?
Okay. All our research, we don't charge for it. It's on our website. Just go to our website, gorozen.com, or just type in Goehring and Rozencwajg Associates. You'll come up, and all our research, podcasts, everything are on that website. And I should also remind you is that a lot of people think we're a research shop. We're not. We're a money management shop. I've been investing in the world of commodities and natural resources for the last 30 years. We have a phenomenal track record, and we're really investors. And our research is really the basis for how we invest money in the global natural resource and commodity markets. But for people that are interested in what we're thinking, go to our website, download it, and enjoy it.
There you have it, folks. Leigh Goehring, thanks for coming back. Hoping to bring you on in the near future again, and just waiting with delight for that inbox for the next one of these to come along.
Okay, very good, Chris. Very good. Thanks for having me again.